Hello, class. This is a podcast to explain the answer to our practice having to do with a mixed up trial balance. So we've got a whole list of accounts here that are actually in alphabetical order, but as we know, that's not how things go on the income statement. We need revenues, expenses, and then gains and losses or other, and then to calculate net income. So to do that, use the Excel spreadsheet. This is what that might look like. Again, there are multiple ways you could do this, but I suggested in the description that perhaps you first do the income statement without any consideration for the discontinued operations. So that means that basically we just find all of the revenues that are listed and add them up. So here's all our revenues. Then we did the expenses. Basically, if it's not a revenue, then it must be an expense, because we didn't mix up any assets or liabilities or anything like that in this trial balance. This wasn't a complete trial balance, just the accounts that belong on the income statement. And then pick out some other. Now, there's nothing, this is a fairly complicated income statement, so whether you have one of these down under other or vice versa isn't that big of a deal. So you get income before taxes. That, I want you to remember, that is the subtotal. Then you do taxes. Then you get net income. And then we subtract out, and this got a little bit separated, the non-controlling interest. Remember, that is always last, as we talked about on the PowerPoint slides. Non-controlling interest is the last item on the income statement. And so after we subtract out that's the net income attributed to BBT. The 75, that's the amount of income made on behalf of the shareholders that own a minority of some subsidiary of this bank. This is BBT Bank. So some bank that they bought, they didn't buy 100%. They bought maybe 70%. This represents the income for the other 30% of that particular subsidiary. And then to review earnings per share, we subtract out preferred dividends, we get net income, and then we divide by the number of shares outstanding to get earnings per share. And that is a required disclosure on every income statement. So we need to get used to the idea that earnings per share is just part of the income statement. So you see there, it's $2.79. That's literally the bank made $2.79 for each share of stock that is available to the public. Now, considering the discontinued operations, the way I like to do that is to then create a column using the discontinued operation. Now, I gave you percentages for each of these items, all right, that were part of the discontinued piece. So the part of the business that's being sold off or discontinued had these revenues. So these are just the percentages given, and the same thing with the expenses. And then I just subtract those from the original to get how much is continued. So if we had 269, we separate out the discontinued operations. So remember, the whole point of discontinued operation disclosure is so that we can compare next year. Next year, when there is no discontinued operations, we should be able to compare to this number, not to this. It would not be fair to compare bank card fees, including the discontinued operations, to next year's bank card fees, because next year we would have gotten rid of the discontinued operations. So that would not make sense. So that's why we do this. We separate out the discontinued operation, put in another column for continuing operations, again, revenues, expenses, other, all right, income before taxes. For all of the discontinued part, that's 114. So if we took the revenue for the discontinued minus the expenses for the discontinued, you get 114. The taxes on that would be at 21%. So that's 24. And so that means that if we take that out of tax out of the original 380, the continuing operation tax is 356. So $90 of income for the discontinued operations. All right. So where does that come in? Okay. So where does that come in? That 90 comes down here and becomes discontinued operations. So what we're literally doing is we're taking all of this, summarizing it into one number, and then putting it back on the income statement. Now, the confusing part is this includes not just the $90, but also the $30 that we had as a gain when we sold the assets for the discontinued operations. If you'll go back to our original problem here, says that we're going to sell it for $420 million, where sales price is $450. It costs us $420. So the gain there is $30. So in the discontinued operations line is both the net income for the year for the discontinued operation, that's what we did here, separated it out, and the gain or loss on the sale, if the sale happened in the current year, which this one did. So those both go in there. So this is 90 plus 30 minus the tax on that 30, which is 6. So you see the formula up here that I used. Okay. So we then have we also have the non-controlling interest, just like we did before. Net income, we subtract out the preferred dividends. We get a new net income for common shareholders, divide it by the number of shares outstanding. Noticing that the net income increased here. Before it was $2,003,003. Okay, now it's 2,027, difference of 24. That's the gain on the sale of the segment of 30 minus the 6. Now, the other thing that happens when you have a discontinued operation is you have to calculate the earnings per share multiple times. So you get it before the discontinued operations, or what we call income from continuing operations. We get it for the discontinued operations and for the net income. So if we had not had discontinued operations, we could have just done one earnings per share calculation. But because we have that segment being sold, we must do it and disclose it for each of the pieces. So this is the amount on an ongoing basis going forward that we would use to compare next year's results, because this part of that results is going away. This is all based on the part of the business that's going to be sold off. So that's why we take it out, all right, and use really this number to compare. This is still important, but this one becomes more of a comparative purposes going forward.